everybody, and welcome back to this very exciting video where we're going to run over some of the top 4 e-commerce stocks, and these are all really solid stocks that everyone should consider to have in their portfolio. We have the first company is JD.com, the Chinese e-commerce. We have Amazon, no need to further introduce them. We have eBay, no need to introduce them further. And finally, we have Alibaba, which we also assume that everybody is aware of. So before going into more details on the stock, we just want to quickly highlight how we see the differences between these companies from a high-level perspective. First of all, we have JD.com, which would more or less be equivalent to Amazon in the US, as they are focusing a lot on business-to-consumer sales. Then you have Alibaba, which is more similar to eBay in the sense that it focuses a lot on consumers to consumers. However, Alibaba is a very diversified company, and it also goes into what Amazon is doing, business to consumers and business to businesses. But overall, to differentiate the 4 companies, look at JD.com equivalent to Amazon and Alibaba a little bit more on eBay. And we will see that a bit in details in the numbers, why this is the case and why it's important to be aware of this. So from the graph, which shows the return year to date on all the stocks, it is by no secret that all of them were a little bit impacted in the beginning with the coronavirus, where they dropped here around March, and thereafter more or less all of them have experienced significant growth in their share price, which is partly due to that a lot of people are doing more shopping online, which is where they have their greatest strengths. So you can see here year to date JD.com has gone up with 138%, Amazon 72%, eBay 40%, really solid growth in the share prices. While as at last we have Alibaba here, who has only gained around 4%, but please note 1.5 months ago it was up with around 40%. But Alibaba is currently being investigated in China for monopoly situation. It's a probe, so that has slammed the share price, especially yesterday. As you can see here, it took a drop with around 16%, so that was a tough day for the stock. However, tough days sometimes means that is good opportunities for us, so we will look into this video to see if Alibaba is actually a buy or not. We are obviously first interested in understanding whether these companies are earning any money in the end of the day, and if we look at the net income for the last 12 months, we can see that that is definitely the case for all of them. Almost 19 billion for Alibaba, 17 billion for Amazon, 4 billion for JD.com, and more than 5 billion from eBay. So really solid numbers across the board from a profit perspective. When we start looking at the net profit margin for the last 12 months, we can start seeing really some difference between the companies. And as we can see, Alibaba and eBay has really solid numbers in 23 to 46% each, while as Amazon and JD.com only has 4 or 5%. But again, as we just mentioned, these are result of the differences between the businesses. So Amazon and JD.com takes on in general inventories, and it fulfills orders via the first party logistics network. So in generally, this type of setup generates much lower margins than, for example, Alibaba and eBay, but it also gives them a much tighter control over the quality and product, and as well the speed of delivery of the services that they provide. So again, this is some of the reasons why the numbers for Amazon and JD.com appears worse. On top of that, these companies are heavily investing in expansion of their logistics networks, and they are launching what we could consider the next gen delivery solutions, including drones, autonomous vehicles, etc. So again, completely different companies for this perspective, and therefore you really need to be aware of that when you look at something like net profit margin, because it is not as bad as it may appear. We can also look at the B/M score, which is just a mathematical model that determines whether a company has manipulated its profit. We want this to be less than minus 2.22, and as we can see, all companies with the exception of JD is good. Again, minus 2.1, really not that bad, but it's not as good as what we would like it to be. We can also look at the Sloan ratio, which identify if a substantial part of the earnings are non-cash accruals. We're obviously not interested in that. So we want these numbers to be between minus 10 to 10%. And here there's only a red flag on eBay, which has a minus on 21%. So that's something to keep an eye out for. Back to the overview, we first looked at the trend of the stocks, and although all of them have gained significantly over the last year with the exception of Alibaba, Amazon and eBay has been trading sideways for more than a quarter now, so therefore we cannot really consider them to be in an uptrend as of today. That is only JD.com, which consistently over the year has been going up. Alibaba over the last 1.5 to 2 months have moved into a downtrend, and that is something to keep an eye out for. If we look at the net income part, all of them were delivering positive results, really strong numbers. On the net profit margin, eBay was doing the best, followed by Alibaba, Amazon, and then JD.com. However, keep in mind that there's difference between the business model, and that is also what drives the net profit margin differences. If we then move into the return metrics, we want to understand how high returns and cash flow margins is being generated by the companies. And if we look at the return on invested capital here, we can see that Alibaba is not doing too well here with only 4%, similar with JD.com, only 7%, Amazon doing a little bit better with 10% and 14% for eBay, who is standing out. If we look at the levered free cash flow margin, it is quite the opposite story. Alibaba is doing fantastic here with 30%, really strong, solid number. eBay again looking well with 17%, while as Amazon and JD.com here disappointing a bit with only 8 and 5%, which can also be again accredited to the business models of the two companies. So again, it's not as bad as it may appear. Next, we want to take a look at the balance sheet and ratios and understand how strong the financial position are of these companies. If we look at the current ratio, we want this to be above 1, and we can see all of them are green, so really good number there. On the cash ratio, we would also in general like this to be above 1. Here it's only Alibaba who is green and the others are red. However, looking at the numbers that they have in cash and short-term investments, a company like Amazon has almost 70 billion, so it's not that bad in the end of the day. If we look at the total assets versus total liabilities, we want this in general to be above 1.5. Alibaba and JD.com looking really well, but the number for Amazon and eBay is still quite acceptable. Similar story with the debt equity ratio. Baba is doing really well here, and the same with JD.com, by far the best. Amazon also really strong, but a small red flag here on eBay on 2.65%, so we will have to understand that in a bit more detail. You can also look at the Altman Z score, which is a credit strength test that assesses the likelihood of bankruptcy. We want this to be above 1.8, and as we can see here, really strong numbers across the board, which again gives us a good confidence when we see, for example, the high debt equity on eBay as an example. We can also look at the Piotrowski score, which is another way of assessing the strength of the company's financial position. We want this to be equal above 5, and as we can see here, again across the board, really good numbers. So looking at both the return metrics and the balance sheet ratios, really strong, solid numbers for all the companies here. So again, back in the overview, we looked at the return on invested capital, eBay doing the best, followed by Amazon, JD.com, and Alibaba. On the levered free cash flow, Alibaba was doing really well. The same with eBay. Amazon and JD.com are also doing quite well compared to the business models that they have. On the total ratio, again, Alibaba the strongest, followed by JD.com, Amazon, and here eBay also doing quite well. On the debt equity ratio, all of them were doing the fine, JD the best, but we had a small red flag on eBay, but not something that we are too scared about when we see the other numbers on the balance sheet. We then move into the shareholder yield, and we want to understand how much value is returned to shareholders through dividend and or buyback. And we're going to skip Alibaba, Amazon, and JD.com as they are literally not paying any dividend and they're issuing a bit of shares. So we're only going to focus on eBay, which has a small but acceptable compared to the industry dividend yield of 1.2. But what is really interesting is when you start to look at the buyback yield on 16.2%. I mean, really great number if you're a dividend value oriented investor. This is a kind of company that you want to look after. Also considering that For example, the dividend has grown with 10% in the last 12 months. So actually eBay has been increasing the dividend that they're paying out to their shareholders. Obviously, we want to understand whether this is sustainable. So therefore, we look at the modified payout ratio that shows the proportion of earnings paid to shareholders in the form of dividends and buybacks. We in general want this to be below 100 because that means that there's room for growth. When it's 112.7%, it's a little bit on the high side. But again, as an investor, we would not mind a small cut in the buyback to get this under, or said in a different way, the dividend yield and buyback yield are relatively safe in the long run. So again, really interesting from eBay from this perspective. We then want to look at the earnings per share and the growth, and we basically want to understand whether these companies are expected to grow in the future. First, we can look at the price to earnings ratio, and all of them compared to the industry are green, which means that they have relatively okay PE ratios. Amazon is a bit higher side here on the 92.91, but what is important to note with Amazon, which is also the case for Alibaba and JD to be honest, but they are still growing a lot. They don't want to pay dividend. They rather want to reinvest it in the business because they believe that there will be more value for the shareholders. Amazon is expanding their presence in the European market within their core business. They have already taken over a lot of the most important markets like the e-commerce in UK, Germany, etc. Amazon is expanding into new businesses like robotaxis, where they a few weeks ago just revealed their new robotaxi Sucks, I think it's called. So again, Amazon is still to be considered a growth company. And again, we really like Amazon, so we have high thoughts about them. We can also look at the earnings per share growth forecast for the next 5 years, and again here Amazon is standing out, which is again why the PE ratio is probably high. They have 36%. eBay compared to the industry low, but we still think, looking at how many years eBay has been around, 18% is quite acceptable, while as JD.com and Alibaba seems to be disappointing a bit on the expected numbers here. If we look at the revenue growth for the last 12 months, we can see great numbers across the board, which is no surprise given the current situation with the coronavirus. All of them are between 20 to 30%, so really solid. We can also look at the average compound annual growth rate, revenue growth for the past 5 years. We can see Alibaba has grown with 43% on an annual basis. That is really, really impressive. Similar, Amazon and JD.com has really shown solid numbers for 28 and 31%. eBay has disappointed a bit here with only 6%, so not as high on the others. However, if we then look at the net profit growth for the last 12 months, Alibaba is disappointing here with minus 15%, and that is one of the reasons why initially the share price got slammed a bit because they hadn't been delivered on the profit growth. While as you can see, Amazon 53%, JD.com impressive 630%, obviously from a lower percentage number, so it needs to be taken with a grain of salt, but however, it's still very, very solid, and it's good to see that the business is becoming more and more profitable. And eBay as well here, 170%, really, really strong number. So again, overall, all these companies are delivering relatively solid number. The only one that we have a little bit in doubt about is on the minus 15% for Alibaba, which is a bit disappointing. And again, considering the intervention that seems to be done by the government in China, it is a little bit more of a risky play as of today. So back to the overall overview, we first looked at the earnings per share growth forecast for the next 5 years, and as we can see, Amazon is by far expected to do the best, followed by eBay.com. Then you have the revenue growth for the last 12 months, again Amazon doing the best, followed by JD.com, Alibaba, and then eBay. On the net income growth, all three companies, Amazon, JD.com, and eBay, has done really well. JD.com 630%, really, really solid numbers, while as Alibaba is disappointing a bit here with minus 15% over the last 12 months. Finally, we want to understand whether these companies are currently under or overvalued, and one way is to look at the PEG ratio in accordance with Peter Lynch fair value. Basically, if the PEG ratio is below 1, it means that the company is undervalued. If it's above 1, they are overvalued. And all the companies, with the exception of eBay, are overvalued. eBay is undervalued, as we can see here, and that is not usual to see that, so that's a really good indication for us that we are very happy about. We can also look at our own estimated intrinsic value, and based on our numbers and assumptions, we basically believe there's an upside at the moment on 30.47% on Alibaba. However, it is worthwhile to note that there is some uncertainties around the Chinese government intervention, which is a bit difficult to estimate, so take this number with a little bit grain of salt. On Amazon, we see an upside on 9.19%. JD.com, although we like them a lot, we think that they have grown a little bit too fast in the share price, so we have a minus 14.26%. And finally, we see an upside on 8.96% on eBay. We can also look at the beta ratio, which is just the stock volatility in relation to the overall market. If it's above 1, they are considered more volatile. And with the exception of JD.com, all of them are more volatile than the general market, but it's not extreme swings that these shares usually see in these stocks. We can also look at some other value indicators. One way is to look at the book value, and basically here, if it's above 1, they are considered undervalued. If it's below 1, they are overvalued, and as we can see, all of them are overvalued from this perspective. We can also look at the relative strength index for the last 14 days. If it's below 30, it's good. It means it's oversold and it may go in an uptrend, while as if it's above 70, it's in overbought territory and it may do a pullback. And as we can see here, there's an indication that Alibaba may go in an uptrend. It has basically beaten down too much too fast. It could be an overreaction that on the Chinese government over the past days. This is something that we at least are seeing, that we think that it's a little bit of an overreaction, and therefore it may be a good time to consider to move into Alibaba, but we will come to that in a short while. Finally, we can also look at the analyst recommendation and what their perspectives are. We are definitely not following them blindly because they often have their own agenda, but it's always interesting to see how their number stacks up compared to our own. And basically, we can look at their consensus price target, which is the middle ground of all the analyst estimates. Some analysts will have a higher price target, some of them will have a lower one. Basically, they see an upside on 41.73% on Alibaba, so quite similar to ours. They're seeing an upside on 13.18% on Amazon. They're also seeing a downside on JD.com, and they're seeing a high upside on 20.99% on eBay. So again, this is one of the few cases where we actually seems to be pretty aligned with the analyst on the target values of these companies. JD.com, we still like them, but it has just grown a little bit much too fast. So based on all the things that we have just looked at, what is our overall value assessment of these companies? Well, we basically believe that Alibaba, Amazon, and eBay today are undervalued. There's value to be captured, while as JD.com, from a short-term perspective, they are overvalued. We're not necessarily talking long-term, but just short-term, we believe that the share price have grown too much too fast. So what is our final evaluation? Which one is the top picks for today? Well, basically, we like all the stocks. We really think that they have solid numbers, they have solid business cases, they are in an industry which we expect will grow in the future, especially around the e-commerce. It will just continue to escalate, which would be a sad thing for the brick and mortar shops. However, in general, that is just the way things are going, and these companies are poised to take a big chunk of the market share. So we believe that all of them are good for the long term. If we take a look at Alibaba, we see this drop as an opportunity to get in at a good price. It could drop a bit more in the next coming days, but as we just said, if you look at the RSI for the last 14 days, it has dropped a lot very fast. So again, we wouldn't be concerned to move into this company today, but it may be okay to wait a few more days and see how the share develops, because it could fall a bit further based on bad news from China. Then we look at Amazon. It's the safe play to buy and hold long term. They're just a solid company overall, and their mantra is to kill everybody, and that's what Amazon is doing at the moment. They're continuing their European expansion, as we mentioned earlier, and they're moving into other sectors. They are not just being stagnant. They want to capture other areas, just as we discussed, the robo-taxis, drones, whatever it may be, and that is why we really like Amazon. We really think that they're good long-term hold, basically forever. Then we have JD.com. It has just increased a bit too much, so wait a bit for the dip. But we think that in the area where they overlap with Alibaba, they may benefit from the issues that they're having and may be able to take or be granted some market share on that. So Again, we think long-term JD.com is a solid stock to hold, but we would maybe consider not to move in as of today. Finally, we have eBay, which is just a great value stock suitable for dividend-oriented investors, but they still have room for growth. And today, eBay looks like a really attractive entry point, so we are already considering now to probably move into eBay as we speak. This was all we had for today. We really hope you enjoyed this video. Please subscribe for future content. Please give us a like, it really helps with the algorithm. Please provide a comment in the comment section. There are certainly things that we are not aware of or we haven't taken notice of, and we always appreciate your feedback to the videos. Besides that, there's not much more to say than Merry Christmas, everybody. It's the 25th of December today. We really hope you have a great time with your family. And otherwise than that, hasta la vista, baby. See you next time.